trader for the IC1 strategy, and I'm the founder of Monthly Caster Options. And then we have Pranav Singh also on the line, and so I'm going to let him do most of the talking because he's going to talk about the DAC1 service and the TOTD, that's Trade of the Day service. Okay. The agenda today is overview of the MCTO services, so I'll give that. Benefits of a directional strategy, and that's when Pranav will be kicking in here. Overview of the DAC1 TOTD services, difference between the two services. Then I think he has some slides on diversification also and how to blend different products together. Okay, just so you know who you're listening, who's speaking. Pranav, he has a BS in Finance and Economics and a BS in Mathematics from Bentley University. And he's a former president of the Bentley Investment Group, and he's a contributing author to Seeking Alpha and Top Shelf Trading, and he's been with MCTO since 2015. And this is me, Brad Renard. I'm traditionally a tech guy. I was in the Bay Area for many years. My background is more in engineering, marketing, sales, co-founder. I've been at a lot of different companies. The main area I was in was chip design software used by electrical engineers to develop microprocessors and memories. My background's in physics, electrical engineering, MBA from the University of Chicago, and I launched MCTO in 2004. Okay, the auto-traded services that we have, DAC1, and that's what Pranav is going to be discussing today. That stands for Directional Alpha Collection, DAC1. And it's for shorter term, 4 to 21 day in duration, long and short directional trades on stocks. For the DAC1 service, which is an auto-traded service, we do have a self-managed version of it. That's the TOTD. But for DAC1, it's auto-traded. We allocate 3% of the cash to each trade, 15 to 25 positions open at any one time. Right now, it's doing well. It's up at 17.7% year to date, and that does include commissions. IC1, I manage IC1. I've been doing this one for a while, 12, 13, even 14 years. It's income generating, non-directional. We sell far out of the money, 85% probability spreads to create iron condors on the SPX and the RUT. I've been mostly focusing on the SPX in the last year, but I will probably be revisiting the RUT again shortly. I do weeklies only. I avoid the monthlies, so no more expiration, European style expiration, which can be very deadly these days. Worked for a long time, but then just in the last 5 years, this market's really changed. And this one's doing well. It's up 85% year to date, and that includes commissions. Time decay, Amir Atabaki runs that service. Similar to this one, he does iron condors and credit spreads, but he does it differently where he opens up 30 and 60 day spreads and then he closes them early. And he turns them into iron condors when he can. Newsletters, we have the MCTO letter. That's basically the analysis that I do weekly for the IC1 strategy. And I just kind of strip out some of the IC1 specific information and I turn it into the letter, the MCTO letter. And that has technical sentiment, macroeconomic market analysis. And it basically can help traders, investors better time their entries and exits, really regardless of what their preferred strategy is. And then finally, Trade of the Day newsletter. This is Pranav, so he'll be talking about it. And this selects 3 trades from the DAC1 service weekly and sends them out usually on Monday, Wednesday, and Friday. Okay, I think I'm going to pass this over to Pranav. And he can take over. All right, Pranav, you should be able to take over here.
All right, I think we're good to go. Thank you, Brad, for that introduction. So just kind of a quick overview of the DAC1 and TOTD strategies. So first of all, they're all debit-only directional strategies that leverage short-term moves. Essentially what that means is we only buy calls and puts directly, no spreads, just simple calls and puts. And we're leveraging those moves, whether up or down, respectively, for calls and puts in a directional manner. And generally, these trades are 4 to 21 days. That duration is kind of extended over a period. And what we do is we buy slightly in the money calls and puts. The reason for that is we want a high delta because these moves are very quick and very short. So we want to capture as much of that as quickly as possible. We don't go far in the money because there are times when the trades go against us, and we wouldn't want a high delta for those moves. Just to kind of give you a background on that, a high delta when when the stock moves in a specific direction in your favor, has a really high return. But on the other side, if it does move against you, it'll have that opposite effect where it'll have a high loss very quickly. So we focus on initial breakouts and breakdown moves, and I'll go into that a little later, what that looks like and how we kind of find those trades. And as I mentioned, 7 to 10 days, 4 to 21 days, generally within that short-term period. And to kind of build on that, it's a high probability core to that strategy. It's really important that we look at high probability trades to find a kind of a better distribution of trades that we can find, a better distribution of trades that have a higher probability of doing well. And finally, we exit when the initial move is complete. So that I'll go into that a little bit later, what that looks like. But essentially, we're looking at that first quick move that happens at 7 to 10 days. And once that's over, we close and we move on to the next trade. So step one is really to screen all optionable stocks. So we have a set of around 5,000 stocks that are all optionable, and we look at 4 to 8 specific technical setups, 4 bullish, 4 bearish, and we look at specific moving average setups, specific exponential moving average setups that look at specific support and resistance and volumes levels that kind of have high probability and create the best scenario to have a best possible trade. Step 2 and 3 in this model are we've created 2 probability models. The first is a probability model, which basically tells us what the likelihood of a trade going up or a trade going down is. And depending on that probability, we'll use a kind of a cutoff. And if it's above that probability, we'll kind of let it go through the screen. If it doesn't, it falls through, and then we don't look at that trade. The second model that we use is to kind of determine how large or how small the move will be. And this model is actually very important in determining when to get out of a trade. When we can find exactly historically how much a stock is moving, depending on standard deviation and other factors, we can know that if the stocks move $10 up or $7 up, we know that generally it's going to stop around there, and that's our exit. And the final step is looking through fundamentals. And this is what really sets us apart from other algo-based strategies. Algos can very easily go through technical models, look at EMAs, SMAs, candlesticks, volume, and other technical indicators, but they have a little bit more trouble looking at revenue growth, management styles, sector strength. Is the financing or the debt levels of the company very strong or weak? And that's really what this last part sets us apart from other strategies that are all completely algo-based. And this actually increases our probability significantly when you look at the numbers. So kind of going over our 4-lever screener, as I just mentioned, technicals is the first step. Probably a success failure, then magnitude of the move, which is very, very important on our exits, and finally fundamentals. So just kind of going over our exits as well. So we have that probability model, that second step. If that probability dips over a certain threshold, we're going to exit out of that trade because that trade no longer has a high probability of finishing that 7 to 10 day move that we talked about earlier. The second thing is a 55 max stop loss. Just kind of take this as a grain of salt because at times, as you know, the option market is mark to market, and that valuation is a little funky at times. So we use this as a soft rule, and generally most trades will close around 35% on average, but 55 is kind of a max at the very, very kind of fringe scenario. And the final thing that we look at is, this is a little bit more technical, but we look at the expected delta is lower than the theta decay. And basically what this means is that over the course of the rest of the trade, let's say we're 5 days into the trade and we expect the move to go on for another 3 days, if that theta decay is lower than the expected payoff that we think is going to happen for that trade, we're going to obviously close that out because we don't want to have theta decay that cuts into our gains when the expected delta is not going to overcome that possibly over the course of the trade. So here's kind of an example bullish trade. As you can see here, the stock pulled up, broke over the 200 and the 50 SMA, pulled back, and came up here. And generally here is where some of our screens start to ping up and show us this trade. So we're going to follow this, look at it, and look at these kind of these resistance levels and support levels. And once you see that breakout, we're going to follow that up and close it right on this first red day. At times, we will close it on that green day, and that really depends on what our probability model shows and what our magnitude model shows. If there's a magnitude model, it shows us that it's going to close right around this 92.5 range. We're going to close it off right there and take our gains. But at times, it does show a little bit more of that move, depending on how the stock's been moving in previous times. So, for example, here, this move right here was very, very large. So it would tell us the model might tell us that the move is going to be a little bit larger, and then we'll see that first red day and close that out right there. Here's an example bearish trade, very, very similar. We see the stock broke below the 200, tried to kiss up to the 50 and came back down. So that first move right here, this red stick would have been a great time to get in and follow this trade all the way down to here and kind of flagged out here. So generally stocks will move in this manner and then flag out until they're finding a direction again. That really depends on what's going on with the stock. So for Owens and Minor, they were going through some management changes and they were going through some regulatory things. So the market kind of cooled down and relaxed, trying to figure out exactly what's going on. And again, we see once regulation and news started to kick up again, the stock obviously dropped off and we jumped into that trade. So kind of just going over when the strategy works and when it doesn't work. As all strategies are, there's going to be times when they do work and times when they don't work. An example is for the last 8 years, we've had a really, really strong bullish market for equities. So if you've kind of parked your money in SPX index fund, you've done very, very well. But also in other times previous to 2008, you kind of see the opposite happen. Similar to that, this strategy has a similar time when that happens. So a really, really good time for us is usually when stocks are uncorrelated and money's chasing strong stocks and dumping weak ones. Essentially what this means is the market is working as efficiently as possible. And when that does happen, stocks that are very, very strong, sectors that are very, very strong, you're going to see a lot of the large players pile into those stocks, and that's when you see those 7 to 10 day jumps or drop-offs. And on the other side, we have highly correlated markets where sectors are trending together. And this will sometimes throw the model off. And that generally, exactly what that means is that when the market is very correlated, so let's say we've had some geopolitical event that's caused a large ramp up in the market, that's going to throw off our put trades or our short trades. Similarly, if the market does pull back, that's going to throw off our bull trades. So on that note also, we've kind of devised a strategy that uses calls and puts to balance that out. And by balancing that out, we mitigate this risk and kind of you get the best of both worlds where if the stock or if the market does fall off or the market does rally, you're going to get returns on both sides. So just kind of breaking down how the numbers work. Success factors for a long short strategy are very important. And this is where we kind of key in to figure out what do we need to do, what kind of what numbers do we need to go for to create the best strategy and have the highest returns possible. So the first off here is having a higher win-to-loss ratio than 50-50. And right now we're around 60-40, which is excellent. So then basically, if you have more wins than you do losses, you will be making a profit, considering all wins and losses are equal. Second thing is winners are bigger than losers. Generally, we have a 1.6 winners to every 1 loser. That's in magnitude, so size. So let's say on average, every winner does 160%, a loser is going to lose 100%. And that's also a factor that we have. All winners and losers, all winners are larger than losers, and I'll go into those details a little bit later. And finally, limiting losses to an average of 35%. So since we are in the option market here, generally you're going to see large winners around 50 to 60% is kind of the average. And limiting our losses to 60% of that is at the ideal space that we want to be in. So which one is designed for you, basically? So DAC1 is designed to work for you without you lifting a finger. This is kind of designed for someone who's a passive investor who just wants to park their money, has another day job, and doesn't want to be watching the market all the time. Auto trade systems kind of allow you to do that, and it's a great system that's free for most systems, for most brokerage systems, and allows you to check in on everything, unlike other closed funds. So let's say you give your money to a hedge fund, generally you won't get a report every 6 months or every month, whereas with DAC1 and other auto trade systems, you can check on your trades any minute that the market is up, and you can just log into your brokerage account, you can see all the trades and exactly what's going on. For the TOTD is designed for an advanced trader that's really watching the markets and wants to kind of break down their strategies and break down information that is kind of inundating them. And there's a lot of information in the market, and this is one way to get really clean, easy access to a lot of that good information. So TOTD, since it is a self-managed strategy, it can be used really in any way that you want. There are several TOTD members who use this strategy with the option strategy, the same DAC1 strategy, but there are also other members who use them for long-only strategies or short-only strategies. Generally, what you can use is you can take that TOTD information, that research, and use that for your own strategy, whatever that may be. just kind of going into what exactly is the same between the strategies. So the strategy behind TOTD and DAC1 is the exact same. We use the exact same screeners, the exact same trades. The only difference is that TOTD selects 3 of these trades at random. Generally what I'll do is on Monday, I'll have, let's say, 3 trades for DAC1. I'll pick the best one and toss that out to TOTD, write up the research and send that to TOTD. Same thing happens on Wednesday and Fridays. Generally, they are Monday, Wednesday, Friday, but that does change from time to time. Sometimes I get a trade on Monday and Thursday and Friday. Sometimes you get 2 trades on Tuesday and 2 on Friday. It really all depends on how the market's moving and when I can get trades out. Just to kind of reestablish this, a lot of people kind of get confused by this. TOTD and DAC1 are the exact same strategy. It's just that TOTD is a smaller sample of all the trades, whereas DAC1 is all of them. So what's the difference? Just kind of reiterating this. DAC1 is auto-trade and TOTD is self-managed. Trades will be executed as setups arise. So as soon as I see a setup, I see the trade and I've done my research, I feel confident in the trade. I'm going to send that to the brokers and that's going to come straight into your account. Whereas TTD is limited to that 3 times at Monday, Wednesday, Friday. And that's going to go out to you and you have to put in that trade, hence being self-managed. Also kind of something to note here, since TOTD is only 3 of the trades per week, it does have a higher variability. Just the way if you kind of think of a bell curve, if you have a lower amount of that sample size, you're going to get a higher variability in what the outcome is. Another way to kind of understand this is if you think of a bag that has 100 coins, 60 of those coins are green coins, the green coins we want because green is always good, and 40 of those coins are red. If you pick out 3 coins, you're generally not going to get as much. Whereas if you're picking out 10, you're going to have a higher chance of getting more of those green coins. So here's kind of an important factor to all investment. Diversification is really about spreading your exposure. So the way I see DAC1 is a very supplemental strategy to many other strategies. It is a higher returning strategy, which helps you kind of mitigate, lower your exposure to it, but maintain the same amount of gains as some of your other strategies. Just kind of going over different diversification methods. First off, options. Kind of options give you an elevated gain because you have a little bit of leverage where you're controlling 100 shares as the cost of maybe a third or a fourth of those. Second thing is individual stocks. Both stocks, this DAC1 really pairs well with IC1 and TD1 because we use stocks and we're doing option stocks as opposed to IC1 and TD, which do them on indexes. So if you do subscribe to IC1 and DAC1, you're going to get a diversification of, let's say, index strategies are doing really well for 3 months, and the DAC1 is not doing as well. You can kind of prop yourself up with the gains of IC1 or TD1, whereas the opposite may happen at certain times when stocks are really volatile and DAC1's doing really, really well, and IC1 and TD1 may not be doing so well. So they really pair really, really well because they have that complementation of indexes versus stocks. And the final thing is mechanical systems. So ETFs, active funds, they're all mechanical, or ETFs are mechanical systems which allow you to track systems, but they're not dynamic. They don't kind of move in and out of different shares. They don't track and move with the market. They kind of just stick something in. They follow that all the way through. Whereas active funds, similar to DAC1 and TOTD, they're moving in and out of different sectors, moving in and out of different stocks, and really chasing the alpha, what is called alpha in finance. Here are the returns for DAC1 going back till July in our inception. So for last year, we closed out 13.4% for the second half of the year, and right now we're up 17.7% for this year. So there are inherently some risks with investing with any strategy. So first off, is, as I mentioned earlier, leverage can be a boon since you do get extra leverage and you can capitalize on that by having large gains on all trades. But it also can be hurtful at times where you have large leverage in a trade that goes bad, and that can work against you at times. And that's really where our risk management comes in, as I mentioned earlier, what we do to limit those risks to 35% on average. The other thing to mention here is because DAC1 and TOTD are high expected reward strategies, you do have inherently a higher than average variability. So if you do look at ETFs and bonds, you may get 2%, but you have no variability, whereas here we're getting 17 to 20% plus per year with a little more variability. So if you kind of look back at the ROI, earlier this year we were doing really, really well, and the last couple of months have been low single-digit losses, where I've kind of been maintaining those losses, but it's going to be inconsistent. Whereas a bond, you just get coupons every month, and that's very, very consistent. Here's kind of the metrics breakdown of DAC1 to TOTD. So right now we've been averaging just under 2% monthly average for DAC1. That's with a 6% standard deviation, and that comes out to a 3.5 Sharp. For those of you guys who don't know Sharp, Sharp is the ratio between monthly return to standard deviation, and it's a good measure to look at any portfolio, to look at what you are paying for in terms of risk. So a higher Sharp is usually better for any kind of strategy. And as I mentioned earlier, the average winner is 40% here, and our average loser is just under our metric of 35%. For TOTD, a similar story, 1.65 for the average monthly return. The standard deviation is higher, as I mentioned earlier. You're going to get a higher variability due to there being less trades being traded in that strategy. The monthly Sharp is 16.7, and the average winner is just under 40, and average loser is just above a touch over our 35 mark. So that's really all we have for you today. I'm going to open it up for questions now.
Okay. All right. Thank you, Pranav. Okay, so if you guys have any questions, please type them in now, and I'll read them off to Pranav, and then we'll answer these, or I'll have Pranav answer them. Okay, we have a few questions coming in. Let's see. I see one from Jenny, and she says, "Are you worried about liquidity when trading specific stocks, especially options on stocks?"
That is a great question. So what we do in our initial screeners is find stocks that are very, very active, have high volumes, and with liquidity, we do kind of look at those and look at options that are obviously trading actively, and that's kind of an initial screen that we do to make sure that we don't run into those issues. And we work with the brokers directly to figure out and make sure that when we are entering a trade that it is very liquid, and if it's not liquid, they'll let me know, and I can make sure that we're not jumping into that trade.
Okay. Sounds good. Okay, Bill, he asks, do you open directional trades using spreads also, or are you only using straight calls and puts, and why?
So we are only using straight calls and puts, and the reason for that is because spreads require timing. So we did actually look into this early on in the strategy when we were developing it, look at spreads, because spreads are generally safer. But what tends to happen is that when the move does happen, a stock will either flag out or to pull back. With the flag out, you're totally fine. You can sit there, you can gain premium, and you can let that money come in. But when the stock does pull back, you're going to see the opposite happen, where the spread is not going to be as well, do as well as the naked call or naked put, where we could have just closed out and taken our gains and walked away. So what we found is that generally trades, there isn't a good predictor to find out whether a stock is going to flag out or if it's going to pull back. And for that reason, we use the naked calls and puts, which allows to ride that trend up or ride that trend down and close out and move on to the next trade.
Okay, that sounds good. Let's see. Sandeep, he asks, can I auto trade IC1 and DAC1 in the same account?
Yes, you can. You just have to have the minimum for each strategy, and you just have to set up the rules accordingly to make sure that you're not overlapping on any of the capital. And we can help you out with that.
Okay, sounds good. Yeah, and also for IC1, I'm Brad, and I run the IC1 strategy. I'm just purely focusing on SPX. That's the S&P 500 index. I open up credit spreads, iron condors on the SPX, and sometimes the RUT. And Pranav's DAC1 strategy does not overlap that at all. So he's purely on individual stocks. Now, sometimes I believe, Pranav, do you do ETFs also, and maybe sometimes the indexes, or is it just purely the stocks?
So there are times when I will do ETFs, very, very rarely. I don't like doing ETFs just because there are a little bit more factors in that throws the model off. There's a couple extra variables you have to throw in the model to figure that out. But generally, it is just straight stocks.
Okay. Perfect. Let's see. Scott asks, do you change the weighting of your bullish versus bearish trades for the DAC1 strategy?
Yes and no. So yes, in the form that there are always bulls and bears in the portfolio, and no, because I don't actually go for a specific distribution. So let's say the market is rallying, and generally you would like to see more bulls and bears in your portfolio, but I don't go for a specific kind of, let's say, a 60/40 distribution, because the models kind of naturally give me those. Where the market is trending up, you'll generally see the screeners pull out more bull trades than bear trades, and that naturally happens with the market. So that's not really something I actively do, but it does happen where if the market is rallying, there will be more bears, or there will be more bulls, and if the market is falling, there will be more bears.
Okay, sounds good. Let's see. Jeff is asking, why do you open in the money calls and puts versus out of the money? Aren't out of the money calls and puts cheaper?
Yes, you are right. Out of the money calls are cheaper, but the deltas are also lower. So what we want to do is capitalize on that gain as quickly as possible. So whereas a delta of an out of the money call would be 30 to 40, we can find a delta that's 75 to 60 to 75, and we can capitalize on that quick movement a lot quicker. Whereas the out of the money option would have to move past that 50 into the money for us to really capture a lot of those gains.
Okay, sounds good. Francis asks, can we have a look at the performance sheets year to date for the various services? So I'm assuming he's asking for, Francis, if you want to see all of the trades, like all the detailed trades, I will have that updated in the next couple of days. It's on the website. And if you want the spreadsheet, okay, he just said all the trades. We each use our own spreadsheet to track the trades. Like for IC1, I have a spreadsheet that I usually just take a screenshot of it, like a PDF, and I will send that to customers and prospects. So I can send that to you. And Pranav, are you doing that also on your side? Do you like take a PDF of your spreadsheet?
If you just shoot me an email at the Pranav@monthlycashtheroptions.com email, I can send you a PDF of everything.
Okay, and Francis, just send you can just send it also just to support@monthlycashtheroptions.com and just say, hey, I would like the spreadsheet for all the services, and then we can get that over to you. Okay. Robert has asked, what's the minimum investment for DAC1? And for DAC1.
So for all the strategies at Monthly Cash Flow Options, the minimum is 10K.
Gotcha. Okay. All right. And Lisa has asked, is your strategy ready for a big sell-off? This market has gone straight up. How will your strategy handle this?
So over the course of the last 3 months or so, I've been waiting for one. To be honest, the models have been telling me that the probabilities for bulls have been falling. We were seeing close to 80% on a lot of the stronger stocks, and that's dropped down to 72, 70 almost at this point. So there are probabilities. They're still relatively high, but I am seeing them fall. So I am seeing the bears start to pull in and have more and more of the portfolio and more of those probabilities. And as for that, the portfolio has been balanced more 50-50, as opposed to where in January and late last year we were close to 70-30.
70 bullish, 30 bearish?
Yeah.
Okay, so you do actually adjust the bullish bearish weighting depending on the overall broad market.
Well, I don't do it actively. I track it though, because I'm obviously looking at the portfolio and I know what's in the portfolio. I don't, like, let's say the market is rallying, I'm not going to add extra bull trades to it just because I think that the market's going to keep rallying. I let the models tell me what to do.
Okay, that sounds good. All right, actually, Francis asked another question. He said, what do you do around earnings? Do you play earnings?
No, we do not play earnings. Whenever there's earnings coming up, I will generally close it the day before or before if the trade's kind of closed out. Generally, the reason that we do that is earnings are remarkably hard to predict which direction it's going to go. Sometimes you have great earnings, great top line, bottom line growth, but forward-looking, the management thinks that something is going to go wrong or something, and the stock falls significantly. The opposite can happen, where a stock that is a very, very strong bear for the last 4 or 5 months has been just dropping and dropping and dropping, and all of a sudden management says that we're looking at new mergers, and that shoots the stock up. So generally, we don't play through earnings.
Okay, that's good. And I have some experience with that. I've been working with different traders over the years trying to find someone that can trade earnings. And with different methodologies, and I've kind of developed a couple myself, trying to find someone to trade it, and either taking advantage of the volatility spike heading into earnings, and or trying to take advantage of the directional move when earnings are released. And I can tell you firsthand, it is really difficult. It still almost seems impossible to me. So if you know anyone that has a good track record and knows how to do it, let me know, because I have thought a lot about it in the last 5 years, and working with a few people that claim to have methodologies, and a few that I was, my own methodologies I was working on, and still I feel like I'm at square zero on it. And so when it comes to our strategies, our thought is to get out before earnings, because it's almost impossible to know how the market's going to react to the earnings. So very difficult. Okay, last call for questions. And any other questions? I think we have, nope, I think, oh, what's the cost? Okay, we have one here from Jeffrey. What are the costs of each service? They're basically about the same across the board, $115 per month per service. Now, TOTD is a newsletter, and Pranav, the cost on your TOTD?
TOTD is $45 a month.
$45 per month, okay.
Yeah.
So everything is monthly, no upfront fees, nothing large upfront. You can cancel anytime. And we usually have a good deal for new customers starting, usually $5 for the first month. So you can visit our website for that. And okay. Well, for now, that was a record. It's only been 33 minutes, so it gives people plenty of time to do other things. So we got through the webinar. So, okay. Well, thank you very much, everyone. Thank you, Pranav. And if you guys would like to contact any one of us, you can contact us through support@monthlycashthroughoptions.com, or Pranav, P-R-A-N-A-V, Pranav at monthlycashthroughoptions.com, or Brad at monthlycashthroughoptions.com. And we also have a phone number. And so I usually do a pretty good job of picking up on most calls coming in. So you can talk with me directly or anyone else directly if you wish. Okay, thank you very much.
Thank you, everybody.
Okay, all right.